听见资本本期视频为您带来的是摩根士丹利在4月15日的闭门会关于亚洲公共事业的行业更新。在当前充满不确定性的市场环境下，公用事业股是不是一个更安全的避风港？这次的分享或许能给你答案。首先聚焦香港市场，哪些公用事业公司凭借稳定的现金流和高股息更受青睐？但也要警惕某些公司在澳大利亚和中国内地的业务可能面临电价下调和投资回报不达预期的风险。还有一家水务公司，除了诱人的股息，会不会有提前续约这样的催化剂？接着看中国内地，电力需求因为电动汽车等因素显得相当有韧性，之前担心的电价问题似乎暂时稳定了。水电、核电、煤电和可再生能源，哪种机会更大？又有哪些潜在风险？比如可再生能源的电价压力。而天然气行业虽然整体需求还在增长，但对经济放缓更敏感。哪些公司因为地理位置或业务多元化更能抗压？别忘了，全球液化天然气价格走势和一项潜在的私有化交易可能带来变数。目光转向澳大利亚，当地公用事业股估值普遍不高，但并非所有都值得买入。哪家废物管理公司是宏观风险下的优选？高股息的天然气管道巨头怎么样？对于综合能源公司，即将到来的联邦大选是关键。两党不同的能源政策，特别是家庭电池补贴和天然气预留政策，可能会直接冲击相关公司的盈利前景。你需要提前了解这些潜在影响。最后放眼亚洲其他地区，电力市场普遍偏紧，但燃料成本下降带来了机遇。哪些国家的哪些公司，比如马来西亚、印度、新加坡和泰国的特定企业，因为受监管，拥有混合发电资产，或者能受益于更便宜的天然气进口而值得关注。接下来是英文会议的全部内容。如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
Hello, good afternoon and good morning everyone. It's Tuesday the 15th of April of 2025. Welcome to this Morgan Stanley Asia Utilities webcast. This is Rob Coe. I'm the Australia Utilities Analyst, and today we're going to have presentations from Eva Ho and Albert Lee, our China and Hong Kong Utilities, Renewables and Environment team, and then Mayank Maheswari, who's covering India Energy, ASEAN Energy, Materials and Utilities, and then also myself. So as usual, please note this event is for Morgan Stanley institutional clients and financial advisors only, not for members of the press. If you are a member of the press, please disconnect and reach out separately. Please note the webcast and your question may be recorded, and there is a text box there if you would like to ask questions. Today we're talking about utilities, which is hopefully a more attractive asset class given what else is happening in the world. So without further ado, let's hand over to Eva to talk about China utilities. Thanks, Eva.
Thanks, Rob. Hello, everyone. I'm Eva Ho. Myself and Albert, we cover Hong Kong and China utilities and renewable energy. Firstly, I will briefly talk about the Hong Kong utilities, and I will pass to Albert to talk on the China utilities. For the Hong Kong utility names, we cover Power Asset Holding, CKI, and CLP. Among the three names, we prefer Power Asset Holding and CKI over CLP for the higher dividend yield outlook. We think the cash flow of the Hong Kong utilities are to remain defensive, underpinned by the fundamental tailwind in some key markets, including UK and some other markets. And for the power asset holdings, they are trading for power asset holdings and CKI. They are trading at above 5% 2025 dividend yield compared to CLP's 5%. And for the power asset holding and CLP, also for the and CKI, the bulk of earnings were contributed by the Hong Kong assets, and the Hong Kong power assets. For the Hong Kong power assets, they are regulated utilities, and their return on their asset value at 8% of the return. So they are pretty defensive, and for power assets and CKI, I think their asset portfolio is slightly better than the CLP for the assets out of Hong Kong. Especially for their assets in the based in the UK. And for the CLP, the only concern we are about is their assets in the Australia. Maybe my colleague Rob will talk more on the Australian market, and also CLP will have some asset exposure in the China's nuclear market, and we think that in the China nuclear market in Guangdong in 2025, they may facing some tariff downside risk, and also the CLPs have a future 3 years plan for invest in the renewable asset in China, and we think also the return may maybe have some challenges. That's the reasons why despite all the have a very defensive asset exposure in the Hong Kong market, we prefer power assets and CKI over CLP. Besides the three names, we also like Guangdong Investment. The Guangdong Investment. I think the company is trading at 6.8% dividend yield, backed by their resilient operation of the Dongjiang water supply to Hong Kong, and also I think for this name, besides the attractive dividend yield outlook, another potential catalyst. The potential catalyst will be the earlier renewable of the Dongjiang water assets ahead of the 2030. I think the timeline will likely to happen in the 2025. That's all my part, and I will pass to Albert to discuss on the China utilities. Thank you.
Thanks, Eva. Hi, everyone. My name is Albert Li. I'm from the China utility team. Today, I will talk about the China gas and power sector. Firstly, we believe the China utility stocks overall offers very good defensiveness amid the current trade tension. The sector in China now offers over 5% dividend yield with high certainty. The trade tariff or the economic slowdown will have some limited impact to the fundamentals of these China stocks in our view. I will separate my discussion into gas and power. In China, first of all, we see the power demand to be more resilient than the gas under the situation of a GDP or export deceleration. In the past few years, we already see the GDP multiplier of power consumption growth in China have been growing. For example, in 2024, China power consumption growth was 6.8%. That's around 1.4 times of the China's GDP growth. So we expect this trend will continue on the back of China's electrification process in many areas, such as EV. Therefore, power companies in China's the power volume will be very resilient on the power demand growth. While looking at the fundamental stableness, China's power stocks fundamental is more driven by or impacted by the power tariff or the power price. While over the past few months, since fourth quarter of last year, the power sector in China has already traded down due to this worry on the 2025 annual power contract. And up to now, the power tariff for 2025 is already known for the annual contract, and we see less uncertainty for the rest of the year on the power price, especially for hydro, nuclear power, and coal power. For stocks, we like Yangtze Power, CGN Power, China Resources Power, and Longyuan Power. For Yangtze Power, as the leading hydro name, this company offers the best stability in earnings and cash flow among other power stocks, and it has the most stable power tariff. As for the CGN Power, the nuclear name, nuclear power also has this long-term growth from capacity addition. Although its power tariff is less protected versus hydro, we see nearly no downside risk for the rest of the 2025, and there will be limited further downside risk for the next year on and onwards. As for coal power, the stocks now offers the highest yield among power stocks. We most prefer China Resources Power, as the stock has the highest certainty in its earnings and yield. Coal price weakness, we believe, will also become a further positive catalyst to the coal power stocks in China. Last but not least, within the renewable energies, we also like Longyuan H share. In the past few years, the renewable power in China has been seeing declining power tariff as the market-driven proportion of this power volume increases. Also, due to the fast-growing power supply from wind and solar, we are seeing the market tariffs are declining. However, we see Longyuan's current valuation very attractive, with 10% ROE, and the company only trades at 0.6 times PB and offers over 4% dividend yield. And more importantly, we also see the company having potential to see an ROE improvement in the next few years from its wind units upgrade opportunities, replacing small wind turbines with new large ones, and to improve the utilization hours. So that's the stock ideas we are recommending in the power sector. Switching to the China gas sector. Firstly, admittedly, gas companies in China are facing a higher risk from the macro slowdown relatively to the power companies. This is mainly because the difference in the business models. Gas distributors in China, they supply gas directly to end users through the pipelines they built. So if certain industrial users, such as the textile companies, if they are significantly reducing their production due to higher export tariff, gas usage will be materially impacted. Although overall we see the gas demand in China are still resilient, there is still this major concern on the gas names in China that these distributors might be more exposed to slowing gas volume growth amid this trade tension. Well, in our view, we think the gas volume growth may see a slowdown for gas names in 2025 versus last year, but there won't be a dramatic drop. China is still seeing gas penetration increase each year, and there are conversions from coal, oil to gas happening every year. A majority of this gas growth is actually from this new user development. So we think this will continue to be the case and drive the gas demand. Under this case, we think I currently recommend two stocks in the gas sector. One is Kunlun Energy, two is ENN Energy. Firstly, Kunlun is a subsidiary of PetroChina. The company enjoys very good presence in the western provinces in China. As China has been migrating certain industries to the west, the western provinces have been seeing a much higher gas demand growth each year versus eastern provinces. The growth rate is mostly double digits every year. So Kunlun's volume growth will be less impacted by slowing economy and slowing exports in our view. As for ENN Energy, we like the stock's diversified business model. Among gas names, ENN's integrated energy and value-added services are the strongest. The two business accounts for more than 40% of its gross profit already after fast growing for the past few years. So when the gas selling business are seeing slowdown for the whole industry, we see ENN has potential to maintain its earnings growth better than most of its peers. Last month, ENN also announced a privatization plan. Its A-share listed parents will issue H-share to the existing shareholders of ENN and will also pay some cash to fully acquire ENN. We think this deal will also offer some riskless return for current ENN shareholders. Given currently share price of ENN is only around 60 Hong Kong dollar, but the offer price is 80 Hong Kong dollar. In our view, even without considering potential synergies in the future, there will be at least a 20% upside from current share price of ENN. Well, lastly, I'll also briefly comment on the current trades between China and U.S. on the gas front. First of all, a majority of the China's gas import, is not from the U.S. Obviously, last year, although we've seen a strong increase in import from U.S. LNG only accounts for 5% of total gas import of China. And this year, with the tariff coming up, we believe China will simply just replace the U.S. LNG with imports from other countries. And in the first 2 months of 2025 this year, before the tariff was in talk, China already see a dramatic decline in the U.S. import of LNG, which declined by more than 40% already. Another theme for the gas names in China is the global supply glut coming up in the next few years. Currently, China, majority of the China's gas import is, no matter it's LNG or pipelines through pipelines, they all, majority are linked to oil price. Currently, we're seeing the oil price trading lower, and this will mean China's gas import costs will be significantly lowered in the coming year. At the same time, if there's a global supply additions dramatically driving down the global LNG price, we also see China's LNG import from the spot market will also decrease. These will significantly benefit the gas distributors business in China, bring down their cost, while also potentially stimulate the domestic consumption of natural gas. So we are still quite positive on the gas sectors in the next couple of years on the global LNG decline theme. And I think I will stop here and pass to Rob.
Great, thanks, Albert. So Rob Coe here from Australia. So our order of preference for our 4 utility stocks in the current environment starts with Cleanaway, an integrated waste management company, and then APA Group, which is regulated and contracted gas pipelines and power stations, and a bond proxy stock. And then we have our 2 integrated utilities where we prefer AGL Energy over Origin Energy. So let me talk in 3 key areas. Firstly, valuation, then secondly, macro sensitivities and how that drives our order of preference. And then lastly, just talk on the catalysts for the stocks, which is mainly around the federal election in Australia. So if I talk about valuation, as a general comment, the Australian utilities valuation is actually pretty undemanding versus peers and versus history. So our integrated utilities, AGL, trading about 6 times EV to EBITDA, and the global peer group is probably 6 to, well, if we include the New Zealand utilities, 13 or 14 times. Origin Energy, which has an integrated utility division called Energy Markets, if we assume certain values for Origin's upstream oil and gas business, and it's holding an Octopus Energy in the UK, then we estimate today's share price for Origin equates to 10 times EV to EBITDA for Energy Markets, so which is actually a very rich valuation versus history and versus peers. So that's why that's at the bottom of our order of preference. And both stocks offering a 5.5% dividend yield. APA Group trading about 11 times EV to EBITDA. That is in line with global energy infrastructure peers, regulated utilities, but it is actually a discount to APA's history. APA is a very dominant player in Australia gas pipelines and has historically traded at 12 to 12.5 times EV to EBITDA. APA also offering a 7% dividend yield. And then finally, Cleanaway trading at 10 times EV to EBITDA. That's a discount to the 5-year average of about 11 times. It's about median globally, and we would actually usually place it in between the highly rated US waste management companies and the more diversified European and Asian names. And then Cleanaway has a relatively fast earnings growth profile, so the dividend yield is only about 2%, and that's also in line with historical average. So that's valuation. In general, pretty undemanding versus history, versus peers, and versus the ASX 200. So if I think about the macro sensitivities for these stocks, which is obviously very, very important in this current market, well, Cleanaway is actually a very uncorrelated stock. It's a domestic defensive stock. It has very, very, very minimal international exposure, tiny bit of correlation to things like plastic and OCC, old corrugated cardboard. Has recently done an acquisition which will give it a very, very small amount of earnings from New Zealand and from the United Arab Emirates. So that's probably the preferable positioning macro-wise for us. Turning to the APA Group, a bond proxy stock. Historically, the stock on a daily close basis would have a 60 to 80% correlation to the Aussie 10-year bond. And also APA would be a second derivative of domestic gas markets in Australia, which I'll come back to in the catalysts. And then finally, the integrated utilities, still relatively defensive versus cyclicals in the ASX and commodities. It's a much more defensive sector, but they still do have earnings leverage to global coal and gas prices, which do influence local electricity prices. And at the moment, the New South Wales electricity price is around $120 a megawatt hour. That's been steady for a couple of years now, and we do actually start to see a little bit of downside risk to that electricity price, which I'll talk about a bit later. So that's the macro positioning, Cleanaway being the uncorrelated one, and Origin being the more cyclical commodity-related one. Now, if I think about the catalyst coming up, well, there's always lots of catalysts in utilities, but the Australian federal election is on the 3rd of May, and we do have some policy debates which will be, I guess, decided at the election. Now, we don't provide a probability assessment for the outcome of the election, and you do also need to consider if there are minority governments and who's holding the balance of power and things like that in Australia. So if I just use the two major parties, where the Australian Labor Party is proposing a household battery rebate, roughly 30% of the 10 to 11,000 Australian dollar installation cost of a household battery. Average household battery is around 10 kilowatt hour energy capacity, and that subsidy, if the ALP policy is enacted, would start on 1st of July, targeting 1 million new batteries by 2030, which would be about 10 gigawatt hours. We've previously analysed such a rollout of household batteries in Australia, and that would actually be material enough to compete with the large-scale batteries that AGL and Origin are currently investing in. And the returns on these batteries we can observe through daily price spreads, so charge low, discharge high business model, as well as cap prices, and more competition would be a headwind to those larger batteries if that happened. And then the coalition, which is currently the opposition party in Australia, proposing a number of energy policies. Let's just put them into two buckets. Firstly, they have some gas reservation policy for the domestic East Coast market. That would directly impact Origin Energy because Origin has uncontracted LNG cargoes, which the coalition proposes to redirect to the domestic market. Coalition modelling from Frontier Economics suggests that the domestic gas price would move from about 14 Aussie dollars a gigajoule now down towards 10 Aussie dollars a gigajoule. If that were to happen, well, Origin and AGL, the direct impact is quite minimal as they don't have equity gas in that that's exposed to the domestic gas price that much directly. Origin has a little bit, but the electricity price would come down. We estimate $20 a megawatt hour. So as I mentioned, currently $120 a megawatt hour in New South Wales, so a pretty material reduction. if that policy were enacted and it had the intended impact of reducing the gas price, which is a highly contentious debate. Finally, the coalition is proposing to build nuclear plants in Australia, and that is a much longer term debate given the construction time. The coalition party proposes to use some of the sites owned by some of the companies in our coverage. First plant would be commissioned around 2035 if everything went to plan. So we'll let you know what's happening in the early 2030s. All right, so that's enough for me on Australia. Now I hand over to Mayank, please.
Okay. Thanks, Rob. So if I'll kind of give a bit of a big picture around how we are thinking around utilities around the world. So I think the view is that we are in a reasonably tight power market in most countries. And the second part, which I suppose even Albert touched earlier on, has been that there is a reasonable amount of supply coming through on commodities, especially for natural gas, increasingly oil, as well as coal. So if we kind of put these two things together, the way we are looking at power and gas utilities in the region is in three buckets. One, the regulated utilities, which in the environment we are in have already started outperforming YTD and kind of gives you a lot more runway in terms of outperformance if bond yields were to come down. The second bucket is effectively on the companies which benefit from cheaper fuel costs. Now, this comes in because we have a view that coal prices are going to kind of come lower. There is a reasonable amount of new LNG as well as natural gas supply coming through. And the third one, effectively, in terms of oil itself and on LNG prices impact, which will show up in Asia. Correct. So these three things effectively help companies which have a bit of a mix of both hybrid and renewable power, because that's the place we want to be rather than pure renewables or just pure fossil. But because in tight power markets, those things actually outperform very well. And the third bucket is the gas utilities names. Now, this is a place where increasingly a lot of governments and policymakers in Asia have started thinking about buying U.S. natural gas. That helps it from the import perspective of energy, as well as lowers the cost by 20-30% for consumers locally in these markets. So if I was to kind of put these three buckets together, the way we are looking at the key names in the regulated utilities bucket and where power markets are reasonably tight is coming through as two names. One is Tenaga in Malaysia, which is one of the countries where you've seen massive amount of data centers outside of the US come through. And that increasingly continues to be remaining a place where we see upside risk in quality of returns, as well as growth in power demand of 2 to 2.5x versus what we have seen pre-COVID. The second place where we think there is upside risk in regulated utilities will be GAIL in India. This is basically the gas pipeline company, has 70% market share for gas transmission in the country, and also benefits from recent policy announcements where regulated returns are actually going higher. So those are the two names, GAIL and Tenaga, in the regulated utility bucket, which we like. The second place is the bucket around benefits from cheaper gas, cheaper coal, and overall commodities. So Sembcorp Industries in Singapore, where power markets are tight and the costs of gas are coming down, you could see higher spreads. Gulf in Thailand is again the similar kind of a story, where these companies are actually building or have kind of put in the capex on gas-fired power plants. They have a good mix of renewables in their entire mix of power generation, so they can play around in terms of making returns through cycle. So that's the place that I think should help as well. And finally, I think in terms of the last bucket, which is around the entire import of natural gas and how that will benefit the entire company. So this is where I think it's an intersection of the first two buckets. So effectively GAIL, Mahanagar Gas, which is a city gas company in India, as well as PTT in Thailand, could kind of benefit quite a bit here, because cheaper domestic gas availability will actually be reasonably positive for all these companies, as well as volume growth should help multiples for these companies. So that's where how we are kind of positioning from a sector perspective. Regulated utilities, companies with hybrid power generation, as well as beneficiaries of higher availability of cheap gas out of the US. So I'll just stop there. We are pretty much at the 2:30 mark here. I will just stop here and basically hand it over to Rob for questions. And if you guys have any other questions, you can just type it into the Ask the Question text box, and we will reply to it now. Rob?
Great, thanks, Mayank. All right, so let me read out. We have a number of questions come in. We may not get to all of them, so we'll endeavour to come back to anyone afterwards. So question number one, probably for Albert. So which countries are the key suppliers of gas to China, and who would step up if gas imports from the US were to reduce?
Sure. Thanks, Rob. I think we are talking about the import LNG here, as China actually also, regarding imported natural gas, there are almost half is coming from pipelines from Russia, from Central Asia, but that will unlikely to see a dramatic increase given the capacity constraints on the pipelines. So basically, we are talking about the imported LNGs. And currently, China, the largest importing countries, I mean, the source of the LNG will coming from Australia, Qatar, Malaysia, and also Russia. These four should be the largest four countries China is importing LNG from. And the U.S. In 2024 only is the fifth largest countries in China. For the China's import. So and with considering the current ultra high tariff, China would just simply switch from the U.S. or temporarily switch to the LNG import from other countries. For the existing LNG contracts with the U.S., most of these buyers in China, they will just resell to other countries to avoid paying that to the ultra high tariff. Yeah. Thank you.